going to devote today's entire video to Dave Ramsey. Perhaps you have watched his show or listened to his show. He's a radio personality, and a lot of people are aware of him, listen to him on financial subjects. I'm going to talk about the things I think he does well, really well, and I'm going to talk about the things behind the scenes that you may not know about. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is April 11, 2023. Let's start with the things. I want to be fair to Dave Ramsey. I have some critique that I'll give you, and I'll try to, in every case possible, I'll try to cite my sources, but I'm also going to give him the positive things that I think Dave Ramsey does very well. First of all, he does a lot to help people get out of debt. That is what he is most known for. He has done probably more than any other person ever in helping people get out of debt. Sometimes people are in debt over $100,000. I've heard of many that are in debt over $200,000, and they have entered into an aggressive program to pay off that debt quickly, usually within a year or two, sometimes a little more. But before that, it seemed insurmountable, and they were sinking. They were just buried in this debt and discouraged. And he gave them hope, encouragement, motivation to pay it off, and they did that. So kudos to Dave Ramsey for what he has done in that area. Secondly, either along the way or after that, he introduces the idea of budgets, learning how to budget and live within one's means. And he gives some very specific methods for that. He teaches through video, does a course called Financial Peace University, and teaches these concepts of debt reduction and budgeting, etc. Finally, he is a great entertainer. So if you like to be entertained and you like the Southern style of sound bites, if you like that kind of humor, you'd probably like him. Very interesting person to listen to. It actually kind of reminds me of Jim Cramer. Jim Cramer is fantastic to listen to. But I would say, in both the case of Dave Ramsey and in Jim Cramer, be careful not to lump together the financial advice you are being given with the entertainment value you are being given. One of the things that Dave Ramsey does is he tries to connect people with a local provider, a local person. Now, this spans different industries. So he's in the financial area, but this covers all the way from investments to life insurance to health insurance, real estate, mortgages, identity theft protection, etc. So he has providers in each of these areas, and usually many of them are local. So for that, he has an arrangement. Now, this gets a little tricky, but some of this it's disclosed on his website. I would say that to his credit, he discloses it, but it's also a little bit in the fine print and not as explicit as you might like, but it's there, so I give him credit for that. When he says he has an endorsed local provider and he wants you to connect with that person, I have a little problem with this, and here's my problem. When he says endorsed, to me that means that I don't think of somebody paying for my name to contact me to sell me something. I think that he's endorsing me because he believes in me, he's putting his stamp of approval on me, and I can trust that endorsement. That's not exactly the way it works. Now, he does go through a vetting, his organization goes through a vetting process with the people he brings on board. But from what I've been able to determine, it seems to me that the vetting process is a fairly low level of criteria. Not everyone gets in, so there is a filtering out of some bad players probably, but and so they talk about vetting, but it's not what I'm used to in being vetted. I've been through the vetting process, and I know what that's like, and he could apply a lot stricter criteria. And but the point of his program of ELPs is to charge them a fee if they meet his minimum criteria, to charge them a fee to participate in the program. That fee is $400 per month to $900 per month, as much as I was able to determine on the internet. So that could be off a little bit because of time, but that's what I found. So that means $4,800 to $10,800 per year per provider. And he has, I read this, that he has about 5,000 providers in these different areas. Some of them in the investment area, some in other areas. And so they pay that to be part of the program, and then they pay a per lead fee. So when you fill out your contact information and send it in, then that provider is being charged a fee in addition to the $4,800 to $10,800 per year fee. The variance in those numbers is based on the size of the market or the city that a person is in. Larger cities probably more, and smaller cities less. And the people you're being connected to, this is where it gets a little tricky, and I'm going to get into some detail here. If you're interested in this, I think you'll find this helpful. If you're not interested, it may not, be something you want to learn about. But the people you're being connected with primarily are people who are licensed to sell products. Sell. That's different than advising. So if someone advises you on investments or acts as an impartial advisor, that's different than someone who's trying to sell you something. This comes down to licensing. Licensing for selling products or some combination thereof is allows a person to, they can present themselves as an advisor, they can have that on their card, but behind the scenes, based on licensing, they can actually be trying to sell you something or have a conflict of interest so that the selling process could come into play and it actually seems like an advising process. When you get into the world of financial professionals, financial advisors, there are about 330,000 of them in the United States, based on the U.S. Census Bureau, what people reported as their profession in 2021. The three broad categories, and I'll bring this back to Dave Ramsey, but it also applies outside of the Dave Ramsey organization. Three broad categories: those who charge a fee only, those who are paid commissions only, and then some combination of one and two. Now, when you have someone work with you to help you with your investments, that person is going to be paid. You are the one who are paying them, whether it comes about through a product or you write a check or it comes out of your account, whatever it is, either way, under 1, 2, or 3, you are paying for it. The question is, how much are you paying, and is there a conflict of interest? If there's a conflict of interest, then you might be sold something that may not be in your best interest. So I'll get into these areas. So the fee-only advisors, fall into a category. They are licensed, generally speaking, under a Series 65 license. Series 65 only. If they have a Series 65 only, that means they are by definition, a fee-only advisor. They cannot charge commissions. So the definition of this is a fiduciary standard, which applies to fee-only advisors. Their fiduciary standard prohibits commissions on products recommended to clients and legally requires the advisors to always put their interest, the client's interest, first, ahead of the advisor's interest. The other side of this is those who receive commissions. Now remember, you, the consumer, you're paying for it either way. The question is, are you going to be sold something or advised on something, or are they going to run into a conflict of interest that you may not be disclosed to you, or you may not be told about? Those who are receiving commissions are under some combination of a Series 6, or a Series 7 license, plus another license. That's usually a 63 and 66, or maybe even a 65. But let's just stick with the 6 and 7 for a moment. If they have that license, that allows them to either completely charge commissions or a combination of commissions and fees. And if they're in a combination where they could be either one, acting in an advisory capacity or in a sales commission capacity, how do you know the difference? How are you able to determine which hat they put on? Are they advising or are they selling? Very different experience. And you know this when you go to, if you go to buy a car, for example. You step on the car lot, onto the car lot or into the dealership, and you expect to be sold. And you expect actually that there's probably information you're not being told, and your job is to go uncover that information and learn everything about it, because there is a conflict of interest between them looking out for your best interest and them making a commission. So you assume it is to make a commission, and maybe information is withheld that you need to know about. And so it's a little different in financial products, but in a way there's some similarities. If you're being sold something, is there something that's not being told to you that should be told to you? Everyone of that 330,000, everyone who's a financial professional is under a license and is subject to regulation. There is a requirement that those who are receiving commissions, they're not under the fiduciary standard, they are under a suitability standard. And this is a much lower bar, a lower set of requirements, because, and I'll read what it says. Suitability standard requires brokers and registered representatives to recommend investments that are suitable for the client. Suitable is a very broad term. However, they are not required to act in the best interest of the client, because they're on a commission. They're representing the company that they work for primarily. It may benefit you, but they are not required legally for it to be in your best interest. Most people are not aware of this. And I read a survey that said 93% of people who are investors would like their advisors to be under a fiduciary standard. But the reality is that's not the case. They may present themselves as if they are looking out for a person's best interest, but legally, if they are under the suitability standard and they are operating under a 6 or a 7, a non-fiduciary license, they are not required to look out for the person's best interest and may have a conflict of interest. Let me give you an example. When I was first married, my wife's mother had multiple sclerosis. Her husband, unfortunately, had died a number of years before that, and she had received insurance money. So I learned about this through the marriage. And at that time, she was contacted by a salesperson who was a registered representative and who operated under a Series 6 or 7 license, and who sold her on investing in a limited partnership with nursing homes and retirement facilities. I have no idea what the sales presentation was, but she was naive, unsuspecting, and probably just about any reasonable sales presentation she would have agreed to, because she didn't have the financial sophistication to ask questions and to sort out various nuances in the presentation. So she gave the registered representative, the salesperson, she gave them her money, the insurance proceeds she got from her deceased husband's life insurance. That money, what happened is the organization that they were selling for paid his company, which is a national brokerage firm, and paid him a handsome commission. So that money came out of there. The rest of the money went to the company that was sponsoring the investment. If the day after she had given this money to them, she needed some of it for her own care because she had MS, eventually MS is a declining condition, and at some point you become fully disabled, and then you oftentimes go into a nursing home, you need 24-hour care. It's not a very good situation on the latter years of an MS patient. So at any point after she gave them the money, if she needed that for income or needed to draw down that money, it was not available. It was completely gone as far as she was concerned. And then that company, even though the economic conditions were favorable in our country at the time, that company, for one reason or another, they went bankrupt. So then all of her money was gone. She was a social worker. She did not have much money. She was raising 3 kids, and it was very difficult. She counted on this money to help financially, and it was gone. That person, the salesperson, registered representative who represented his company first and not her, he was not doing what was in her best interest because he was not legally required to. And that's the way the system works. Now, when you come back to Dave Ramsey's organization or to any individual who is under a Series 6 or a Series 7 license, they may not do that exactly, but they are not under the standard of being required to look after the best interest of the person, no matter what the sales presentation, how well it is done. It takes them off the hook from doing that. So sometimes a person who has a 6 or 7 license and another license, sometimes they can potentially act in the best interest of their customer, potentially. But how do you know when that occurs? And are they required to? The financial incentives, just like in this case with my deceased mother-in-law, the financial incentives are in place for them to not do what's in your best interest and go where there's bigger money, which is in a commission product. Either way, whether you pay a fee, whether it's explicit or implicit, or you pay a commission, that's usually implicit. regardless, you're the one paying this person. The question is, do they have a conflict of interest, and are they operating in your best interest? So I put together some questions that for you, these next two slides I think will be very helpful. Here's questions that you can ask a financial advisor to sort out, is there a conflict of interest, and are they operating in your best interest? Now, I teach a course on this called How to Select a Financial Advisor at the local college. And it's very interesting to me, the reaction of people, because when they start the course, they realize they had no idea on what to ask and what to look for and so forth. And by the time they finish the class, they're better prepared to ask these questions. So I'll go through, these are just a segment of what I teach, but I just put together 6 of them here I thought were really helpful for you to be able to sort this out. So again, this applies to whether you're talking to a Dave Ramsey ELP or someone else. Whoever you're talking to, these are good questions to ask to sort out this area of conflict of interest and financial incentives. Number 1, is your company a registered investment advisor / fiduciary? If the answer to the answer is, by the way, a simple yes or no. To me personally, if there is an explanation, it's kind of no, they won't say no, but if they try to give a spin to it or an explanation, that basically, for me personally, that's a red flag. So if you press on this issue, they're either a broker-dealer, brokerage firm, or they're a registered investment advisor, which means they are probably under a fiduciary standard. Now, they could be under a fiduciary standard or choose to take that route without being a registered investment advisor, but it gets murky. Those are few and far between, and I think they are, the conflict is there potentially to go to the side of commissions, which means non-fiduciary. It's complicated. I'm just trying to make it simple to say if the answer to this question is yes, that's a clear check mark as far as filtering through question number 1. Number 2, it kind of goes with number 1, and it says, are you a fee-only advisor? If the person is under a Series 65 license, that means that they are a registered investment advisory firm, and they, the people underneath it, are investment advisory representatives by virtue of the 65, and that they are required to be a fee-only financial advisor. This means they cannot accept commissions, which means there is potentially not a conflict of interest. So what you want to this question is you want a yes answer. If it is a no, or if there is spin to it, to me personally, that's more of a red flag. What licenses do you hold? Again, I've gone through this, but again, you want to come back. Hopefully the answer is Series 65. If it is only Series 65, then that's a very easy check mark that you've gone past that filter. If you get into the 6 and the 7 with some other license, if that 6 and 7 is present, to me personally, that is a red flag. It says that there is the opportunity to receive commissions and for a conflict of interest and financial incentives to be in place that are not in my best interest. Now, the next question is not as important, but I prefer it. Are you completely independent? If I were sitting as a consumer, I would prefer someone who was completely independent. They don't have to be, but it's a check mark for me if that is a yes. If it is not, I would have them explain the detail of why that not being independent is okay. You can sort out that question for yourself, but I would hopefully that's a yes. Number 5 is the most important question. Matter of fact, you could almost do away with every other question if you could get this answered correctly. This is essential. Will you sign a fiduciary pledge to always put my interest ahead of your own? And I'll show you this in the next slide. If there is hesitation, or the answer is no, or there is spin, to me personally, that is a deal killer. I want someone who has my best interest at heart and is willing to commit that they are putting my best interest at heart. And this is irrespective of it being a Dave Ramsey person or otherwise. I don't want to speculate on how many of the Dave Ramsey ELPs would not sign this, because I don't know that. But I think this is the question that you should ask. And if you want someone to work in your best interest, this would be one way to filter that and to sort it down so that you get what you're looking for. Now, Dave Ramsey talks about this idea of one of his requirements, and this is part of the vetting process to the ELPs. Do you have the heart of a teacher? He says this thousands of times. Do you have the heart of a teacher? You should have someone who has the heart of a teacher. Okay, in dealing with people, I have found that some of them want to be educated about what they're doing, and some of them are not interested in that. It's just too complicated. They don't have the time for it. But clearly there are people who want to be educated. So my question on number 6, and this is for you to determine the answer if you like the answer, how will you help educate me? If there is hesitation or an unwillingness to educate you or spend time with you or make sure that you know what's going on with your investments, if there's a hesitation on that, like how your money is invested, to me that's a red flag. And particularly I think it goes against what even Dave Ramsey is saying is important to him, and that's to have the heart of a teacher, which means education. So now here is the fiduciary pledge. This is from the Institute for the Fiduciary Standard. And it says this, and I would just write this out. When I finish this video, you can write down the questions of the previous slide and this slide, and I would just write this on a sheet of paper and ask them to sign it. I promise to serve the client's best interest, act in utmost good faith, act prudently with the care, skill, and judgment of a professional, avoid conflicts of interest, disclose all material facts, and control investment expenses. They're either going to sign it or they're not. If they don't sign that, I don't know, it's up to you. I read this article by this guy. It's on the internet, a guy named Larry Ludwig, and it caught my eye. And it says, Dave Ramsey's 12% return isn't reality. He constantly talks about investing in good growth stock mutual funds. And I have a problem with this because I saw an interview he did with a person who was questioning him on his numbers. And the guy said, you're using average return or average rate of return, and the financial industry and those who calculate rates of return do not use that method. They use a compound annual growth rate of return. And he, tried to diminish their comment, and then eventually finally conceded that, well, there are different ways to do it, but the way I prefer is average rate of return. What that means is, and this is misleading, I'll be honest with you, this is misleading. If you stack up, had a rate of return of this year, this the next year, this the next year, you add them all up and divide by the number of years, you get an average rate of return. Most people don't look at their money that way. It is compounded. You have so much this year, and then you have a higher balance, and then you compound that rate, and then over time you can say the compound average annualized rate of return compounded is X amount, because that's how we look at our money, and that's how financial professionals calculate rate of return. Dave Ramsey is not a financial professional. He's a radio host and an entertainer. He is not held to any standard. He does not have any license to do this that I know of. And so he can say things like this without being regulated. But those who are under regulation would probably not use this, or they would use it with a very strong caveat. So because an average rate of return misstates the experience that a person is going to have that you expect on a compound rate of return. So this guy, the blogger, Larry Ludwig, and he's just a blogger. He's not an expert. He's, puts blogs out. But he wrote some information on this, and he kind of tackled this subject. And so he took the 12% average rate of return that Dave Ramsey says over the last 70 years, he has a mutual fund, I'm paraphrasing, mutual fund that has earned 12% rate of return. Well, Larry Ludwig went back and, according to the article, said the only one he could find, I've not verified it, but the only one he could find was the Vanguard Wellington Fund, which actually did go back 70 years. And the date of the article was in 2020, so December of 2020. So it's about 2 years old. And the rate of return of Wellington at that time from inception using the compound annualized rate of return was 8.33%. And that is what it is. And that's as good as you can get for 70 years out of a mutual fund, according to Larry Ludwig. Dave Ramsey insists on good growth stock mutual funds having a 12% rate of return over 70 years, according to Larry Ludwig. So I think that the difference is a couple of things. One, the methodology is not one that's accepted generally, and the other is there's expenses and maybe there's distributions or taxes or other things that come into play that cause but they do reinvest the dividends. So, with the reinvestment of dividends is still only 8.33%. So there is probably also a subtraction for expenses, commissions, and trading. And most people are not looking to buy something for 70 years. And what if it doesn't perform well? You go into something like, for example, Fidelity Magellan Fund in the 1990s was phenomenal. It outperformed, as I recall, it outperformed almost everything. But then Peter Lynch, the manager, retired, and then the tech bubble, burst, and the market collapsed with the kinds of things that fund was invested in, and it was horrible. It went from the most wonderful to probably one of the most horrible. And so at some point along the way, you would say, I want to get out of this. And so sometimes when you make a hypothetical situation of you could hypothetically get this, he doesn't use the word hypothetical. He just uses that word 12% without really citing much sources or much in the way of disclosures. anyway, I think I think it's misleading, and even his ELPs criticize him for it because when somebody comes into their office, they go. I've read this numerous places where they say to the person, "I want that fund or the set of funds that Dave Ramsey gets 12% with." Well, they have to back them down because they know they can't deliver that, and it's unrealistic. So, but they have to be careful not to criticize Dave Ramsey. The other thing that's important about something like this is he never talks about, and this is a criticism, he never talks about the risk that is associated with this. So when you go for a high rate of return, let's just say it's Fidelity Magellan in the 1990s, or any fund that's a high growth rate fund during the growth years, what they should be telling you is that is subject probably to the deepest loss and the highest risk during a period of decline. And we know there are going to be periods of decline. He never talks about that. I've listened to him before. I've always heard him throw out this 12% number, and he moves on. It's just a very quick one-sentence soundbite and with no disclosures. The other thing that is, as a person gets older, they should not be in good growth stock mutual funds completely. They should have a more balanced approach. They should have something that protects risk better. And this is where the financial advisors come into play. And you say, do you want to lose half your money or 40% of your money or 30%? This happens a lot with growth stock mutual funds. And people get eventually to the point where they go, no, I really don't want that. So that 12%, again, there's another reason why it tends to come down, because people just aren't willing to take that rough of a ride with their investments. I want to read something for you. This will take 2.5 minutes. So, but it was as I was looking on the internet, trying to learn as much as I could about Dave Ramsey and what goes on. I found this. It was very fair. I thought a very fair statement by this guy that wrote this. I don't know if it was. I assume it was a blog or a comment. I found it, and he tried to be fair about it. But it was a criticism of Dave Ramsey's organization and who he ended up with, for him personally, as an ELP. Now, in fairness, not all ELPs are like this. Each one is different, and you have to do your homework. But I thought this was stated something that Dave Ramsey kind of makes it sound like this is going to be a wonderful experience. He implies that, and his advice tends to be, I think of it as kind of a one-size-fits-all. You should do this, you shouldn't do that, and I even remember where he puts down gold and silver. It's a horrible investment. Well, it's not an investment. It's an insurance policy against a declining value of the dollar. Or where he criticizes permanent life insurance. Well, I have permanent life insurance. I bought it. I'm glad I have it. Term life insurance eventually becomes too expensive as you get older, and it's like, and you don't get anything for it. There's a value to each, but he doesn't sort that out. He just says permanent life insurance is horrible. Well, without giving any qualifying statements. So when I hear his comments about gold and silver or permanent life insurance, as being flat out absolute statements, one size fits all, it diminishes his credibility to me of, on whatever he says about his 12% return or ELPs or whatever. Anyway, this is this comment that this person wrote, so this will take 2.5 minutes, so bear with me. When I started my financial journey, I knew nothing about money or investments. Luckily, I didn't have too big of a debt problem of my own, but I had a lack of financial investment knowledge and proper money management. I was able to save money, but I didn't know what to do with it. I listened to Dave Ramsey on the radio for investment advice, but all he ever recommended was to call one of his ELPs or endorse local providers. The idea of meeting with a financial advisor didn't sit well with me because I knew most advisors work off commissions. So I guess, I don't know what the percentage is, but I think there's quite a few that do. However, I found that Dave Ramsey sounded trustworthy, and I subscribed to much of what he taught. Due to this, I logged onto his website, put in my zip code to find a local ELP that I could visit. With a quick search, I was referred to a local investment firm that quickly called me to set up a consultation. I did some research of my own on Dave's ELPs. I found that in order to be a Dave Ramsey ELP, you have to pay several $100s per month to Ramsey Solutions, and you have to agree to have the heart of a teacher. In addition, you are required to subscribe to his methodology in order to get the endorsement. The more I researched ELPs, the more I found that they were a big money generator for Dave Ramsey. This isn't to say they were not trustworthy, but it made me skeptical. When my wife and I walked into the office, I scanned the ELP's personal pictures sitting on her desk, and I looked at the disorganization of strewn papers everywhere. First impressions are important to me, and it didn't seem like this ELP was squared away or on top of it. We sat down and chatted to get to know each other. This woman was in her 50s and was talking about how she is doing her best to put her daughter through college. As we made small talk, I was judging this woman during the conversation. If I'm going to be receiving financial advice from someone, I want to make sure they have their own financial life in order. The more I talked to her, it was clear she was knowledgeable about investments, but she didn't necessarily know how to handle her own daily finances. Needless to say, we spoke at length about my finances and my goals and dreams, and I told her I would consider working with her in the future. We parted ways, and the truth is, I had no intention of returning. She only solidified my fears that I started out with. She was not the expert I was looking for in order to educate and direct me with my finances. The ELP, this woman, called me several times after that, obviously desperate for my business, which only pushed me further away. So again, that's an isolated situation. Each one is different. I don't want to paint everyone with that same brush, but if there is vetting that goes on, apparently this person, as an unsophisticated person, was able to vet her in his mind in a way that Dave Ramsey didn't seem to do. So thank you for watching. I hope I have not offended you if you're a follower and like working with Dave Ramsey and his ELPs. But my goal was to shed light on what goes on a little more than what you might hear on the radio from an entertainer like Dave Ramsey. Hopefully it's helpful. If you have questions or comments, feel free to leave them in the comment section below. Finally, I wanted to end with this cartoon. Investing in this economy is not a gamble if you follow my simple formula. Buy a little stock. If it goes up, sell it. If it doesn't go up, don't buy it. Hope you have a good day. Thank you for watching.